So a little bit about me. I'm a director here at Republic, which is a spin out of AngelList that allows anyone to invest in startups. I previously been on the investment team, so I went from associate to principal, so I know what types of companies we look for, and I'll get to that in a little bit. And I'm really just focused on reaching out to quality founders and amazing partners like WeWork Labs. So thank you for having me again. I previously sold my soul for a great price in investment banking and private equity after majoring in economics from Harvard. And some fun facts is that I hate running, but I do it anyway. I ran 100 miles in May and I regret it. I can't cook, but I'm trying, and I am an approachable person. So please always feel free to DM me. You can email me. I'll put all of that information either in the chat or a little bit later. So here's the universe that I usually like to post to different founders in terms of what your options are. And this is, by the way, excluding venture debt, because Denisha, who's going right after me, will be explaining all of that to you. So in terms of alternatives, there are, I guess, 6 buckets that I'd like to highlight. So one is the friends, families, angels, which a lot of people actually prior to this had questions on. So I will be touching on that a little bit right after this, actually. So, but that being said, there are definitely lots of ways for you to find angels, to figure out which ones are the best ones for your company, and also just get some fellowships like the ones that I mentioned here, like in Camelback Ventures. They actually replace a friends and family round, but for underrepresented founders across the country. So I'm a really big fan of their program. There's also grants and competitions. There are some folks that, have made billion-dollar businesses, like Twilio, for example. His first check into the company was actually through a pitch competition where he won 2nd place. So these are really great non-dilutive solutions where, the National Science Foundation is right now, especially now because of COVID, is looking for more opportunities to invest in startups. SBA has a lot of grant programs as well. 2 I wanted to highlight for women are SoGal Ventures and Black Girl Ventures. They both have amazing pitch competitions all around the country. And by the way, if you do want more information on resources or pitch competitions, opportunities, all of that, I do have a newsletter, and I'll put that in the chat too. In terms of bootstrapping, if you want to find partners that will not, compared to like the VC timeframe where they expect you to, exit anywhere from 3 to 7 years, right? Bootstraps VCs are a little bit more focused on creating sustainable businesses. And so there's Collab, which is mostly focused on Black founders, but there's also Earnest, which is a shared revenue agreements. Take a look at that. And Indie VC, which is known for their creative models as well. So Denisha, I think you can also speak to that later. And so definitely take a look and see if those are the right partners for you, because if you're trying to build long-term sustainable businesses, VC might not be a fit. And so this second row right here, I like to think about it as the crowdfunding, crowd investment section. And so in terms of rewards crowdfunding, we have Kickstarter, Indiegogo, which you'll hear of later, but iFundWomen is one that I do want to highlight because they are focused on women, they coach you, and a lot of it is rewards crowdfunding is a lot more when you're still pre-product, pre-revenue, and you just want to validate a concept. And so that's why you see a lot of times it's consumer, a lot of it is just ideas, but they're trying to bring it to life. And so that's a really great way for you to fund your project or your company is when you are thinking about how is it going to fit into the market. So this is a good way to validate it. There's also microloan crowdfunding. I did want to highlight Kiva. It's a great way to also get a ton of folks to from all around the world really to lend money to you, and then you return it. And they have a ton of programs as well that will allow you to not actually return it without interest, with interest. So it's actually cheaper than a lot of other options. So take a look into Kiva. And then last but not least is crowd investing, which I like to consider it is the in-between child between angel investing and rewards crowdfunding. So it's kind of in the middle where you're really empowering people to be angel investors in your company without messing up the cap table. And we'll get into that in a little bit. I did want to highlight these resources. I know that the WeWork Labs team figured out that this was something that you guys are really interested in. So please take a look at these lists that are out there. Many of them are, I mean, it's kind of wild, to be honest. At some point, this will all get aggregated into one giant list, but I think this is really helpful just to get started and figure out if, you know, what types of angels are you looking for? Are you looking for like active versus passive angels? Do you want angels that will really add a value add, or do you just need their money? Take a look at angels who like really, they are maybe leaders in the space that in the industry that you're in, or maybe you just want, you know, to be mindful of the construction of your cap table and you want 50% women or 50% underrepresented folks. This is all things that I think if you have these aggregators at hand, you'd be able to then sort through them and figure out who it is that you really want to talk to. These are also just investor directories that I like to highlight. I put First Angel list because that's the one that we spun out of, but there's also Gust. First Dollar Deal is actually pretty interesting. We do source some of the companies that are on our platform now through them. Founders Nest, Funding Post, Conduit is relatively new. It's built by Next VC, Signal, and then obviously Republic. But I'll tell you about that a little bit later because Republic's a great way to kind of get some of those smaller checks into the door without having to ruin your prospects of the future. So that's kind of a great segue into kind of my advice for when you're looking into angels is to, one, make sure that you don't have too many. I just interviewed an angel that was like, if I see more than 50 people on your cap table, I'm running away. Right. And so you definitely want some of those bigger checks to come from angels and potential VCs, but you want to keep it clean because angels don't come just with the money. Sometimes they'll ask you for things, they'll distract you, they might like be adding or be more harmful than it's worth. And so it's just something to keep in mind is to don't source from just anyone. You have to make sure that those angels are strategic and the value add that you need. The data room needs to be tight. And I say this just for life in general, right? Make sure that your house is in order because angels will ask for many different things and time also kills deals, right? So you want to make sure to have everything handy and really try to strike when the iron's hot. I just say be upfront because I think angels, especially the more that they see deals, the more that they realize that they can call on people when they are definitely playing games. And so you want to make sure that you are upfront as to where you are in your business, as to what you're doing and how you're going to take this money that they're going to give you and then take it to the next level. I can go on and on about this, but just trying to keep it brief for now. I did touch upon this, active versus passive angels, making sure whether or not all you want is a check or you want someone that is strategic and might actually support you in your industry. And last but not least, trust your gut. Due diligence does work both ways. Make sure that this person is real value add rather than just what might be a pain in your butt later on. So there's that. Here's Republic then. I'm sure you guys have been waiting for this the entire time. But essentially Republic, if you go to our website, republic.co, we're essentially a spin out of AngelList. We allow anyone around the world to invest in startups. We've helped over 200 startups raise over 50 million, and we have 700,000 people who are now on our platform. The average raise last year was 500K, and we accept less than 1% of startups. So it's a crazy number, but it's also because we have so much deal flow that, you know, we just have to parse through everything and really present the best deals to our investors. And what's really awesome is that just through the nature of the platform, 40% of our founders are women and about 20% are Black and Latinx. Also, side note, Beyonce knows who we are. This past weekend when Beyonce posted her Black Parade directory for Black-owned businesses, we had Sienna Sauce, who's raising right now. And she didn't just put her website, she put the Republic website, and that drove tens of thousands of investment just through that. So she knew that you had to actually go to Republic and invest in Black businesses, not just buy from them. And so I thought that was very powerful. Oh yeah, and we have a ton of co-investors with our deal, so Sequoia and Andreessen and all of that, but that doesn't matter because we have Beyonce here, so. why Republic, right? We hear this so many times. I am actually, by the way, putting tweets on the right side of my decks because sometimes it's just easier to hear it from the people. But why Republic is to really, if you are in any business really, B2B or B2C, it's a great way to not only engage your current customers, but also expand your network and try to find new customers in order to boost key growth metrics. This is actually really great to position yourself for the next round where, you know, you might have more leverage because now you have X many more customers. So that's something that's key here. It's to generate really partnerships leads as well. We have had tons of examples at this point of people who are truly finding new partners because they're able to promote themselves and people will find them. So they come to you. You also find follow-on investors. We do have a company called Sapient. They raised a full $1 million. And what was great about that was that there was someone who invested only a small check, but then said, hey, my brother actually runs several NFL stadiums. And, you know, since you're a energy saving play, you know, this might be a good fit. And through that, they got $750K of like committed pipeline from them. And that's something that, you know, you can't really replace or get from just any other site. So another great way is to kind of use a marketing campaign with Republic as just pure marketing, right? And I'll kind of run through these now. I feel like I'm running out of time, but you also maintain company control, right? So you set the valuation cap in the discount. And once again, even though you might have 5,000 investors in your campaign, they all roll up into one line item in the cap table and they have no voting or information rights. They also only get a return when the company either IPOs or gets acquired, or there's a change of control. But essentially, that's something that to keep in mind is that that's very powerful. There's no impact really on follow-on rounds because 70% of startups have raised after Republic, which is a pretty impressive number. And it's just affordable and powerful. Anyone can actually invest in your startup even with a credit card. So that's something to keep in mind. And our fees are actually super competitive. And we're just part of a large alumni community in terms of we have 150, actually 200 startups now. You'd be part of that. We're actually building out our portfolio services. And so that's something to keep in mind. What's a Republic fit is if you are US incorporated. We go anywhere from pre-seed through Series B. Actually, we have a company right now. If you go to republic.co/kangaroo, you'll see they're raised 18 million. They're backed by Craycroft and Lara Hippo. And they're actually using this as a marketing play. And so that's actually a great example of someone who may not need the money as much, but is using it for marketing. We do want post product and post revenue. We'll talk a little bit later, I believe with Slava about, maybe doing a crowdfunding campaign for pre-product. But if it's pre-product, it really does need to have a compelling reason to be on Republic. So whether they are backed by a notable VC or they have a serial exited founder or they have a large community. All those things could be key to being part of Republic. We do want month over month growth for the most part in terms of traction. I will say that because of COVID, that has derailed a little bit of the businesses, but we like to take a holistic picture. A great team and solo founders are okay. Also husband-wife teams are okay. I know for a lot of VCs, they say that that's not kosher, but for us, we actually embrace it. And last but not least is runway. We do want to make sure that you at least have 4 months of like minimum of cash in the bank in order for you to run the full campaign. This is kind of the timeline, and it does take anywhere from a month to 3 months, month to like 6 months, depending on how quickly you move. And through the campaign generally runs 2 to 3 months, and that's why a lot of people actually run a campaign concurrently with raising from VCs. And so this is just some tips. Have your house in order, as I mentioned once again, because this process does take a lot of time. So it's a matter of like making sure that we have your financials are get compliant, that, you file what's called the Form C with the SEC. We'll actually hold your hand through all of that, but it's a great way to kind of get ready for when you go to VCs, because we actually help you through this process, tidy up your house. We actually have a dedicated campaign manager for you. So to create your outreach strategy, to really make sure that you follow our playbook, because it is a very specific playbook for crowd investing. It's very different actually from crowdfunding. But last but not least, the last two I'll run through, which is really just engage with the people who are asking questions in the discussion board, and to constantly post updates. People want to see that you're growing, that you're scaling. We actually help with a launch email when you launch on the platform. We constantly put your updates in our newsletter. And then last but not least, we have a closing email that we send out to everyone, to all 700,000 folks. And there's a lot of FOMO that's created from that. So we do see a spike at the end of campaigns. So I'll stop there. I'm trying to see if I'm good with time.
A little bit about myself. My name's Denisha Kulor. I work in the early stage technology practice at Grasshopper Bank. Before joining Grasshopper Bank, I worked at Silicon Valley Bank, based in New York, focused on working with early stage companies from inception to about Series A. Prior to getting into venture banking, I was a founder myself. I built an ed tech startup called Pluck, designed to help colleges meet their enrollment goals as students apply for free. In addition to working with founders, I like to spend my time writing. I have a music tech newsletter called Stan, and then I also recently launched a newsletter for founders around pitch competitions, grants, and non-dilutive funding. So for any founders who are interested, you can check it out at friendsandfamily.substack.com. A little bit about Grasshopper Bank. So we are a digital first venture bank. And what that means is we spend our time banking companies in the innovation economy, as well as the funds and investors that invest in them. We've raised over $131 million. We are chartered by the OCC and really dedicated to democratizing access to good business banking everywhere. So with that being said, one of the key products that we offer, as well as other venture banks, is venture debt. So that's what we're going to be touching on today. The first thing that I want to start with is thinking about venture debt in a way that's complementary. So venture debt is typically not a substitution for a type of funding. It's meant to be a complement to raising a round, and really think of it as a non-dilutive runway extension. So it's not going to be the sole source of your runway, but rather adding on to your runway, and you're giving up less equity to do so. So what is it, right? It's a type of financing for companies that have raised institutional venture capital. And I really want to put an emphasis on the institutional venture capital part. We're going to touch on this a little bit more later, but it's important to understand how venture debt is underwritten and who the investors in your round play a part in that. So if you're a founder and you're thinking about pursuing capital, and maybe venture debt will be key to your strategy down the line, it would actually in some ways benefit you to consider institutional investors over maybe friends and family or angel investors, even if they can offer you the same amount of capital. So how can venture debt be used, right? So at its core, it's for your working capital needs. Most times it's helpful to a lender to understand what the sole purpose of it is going to be used for, but that's really up to you, right? So financing an acquisition, expanding or extending go-to-markets, really as the founder, you're driving what the use of it is. And with that being said, though, most lenders want to make sure that you have hit at least some type of product market fit. It's very key to remember with venture debts or just any debt in general. We think a lot about equity risk versus debt risk. And so for debt risk, we're acutely concerned about our repayment sources, and how we're incentivized on a good deal looks very different than how an investor is, right? So investors are going to take outsized risk because they're expecting outsized returns. And as such, there's stages in which they feel more comfortable playing. How does it work, right? So I want to talk a little bit about the process and underwriting. So just getting started with the process, most founders evaluate a variety of venture debt players. So when you're looking for folks in the space, it typically comes down to banks or funds. So the Grasshopper Bank or other banks, as well as venture debt funds. One thing you want to think about when going with a bank is most times you will have a lower interest rate, as the cost of capital for a bank is deposits that they have on board. Whereas for a venture debt fund, their cost of capital comes from raising money from their LPs, then deploying that capital and then getting paid back from with the interest, and then also having to return that fund to their LPs. So you engage with banks or venture debt providers to start the process. They're going to want to understand rather high level what the use of the funds are, how you plan to use the funds, and how long you plan for those funds to last. And they're also going to want to get visibility into your current fundraise. So are you raising capital right now? What's the amount of capital? How long do you plan for that capital to last, and who the investors are that are providing that capital? Now, in terms of calculating what the amount is, as well as the methodology for getting paid back, most times you typically never see a venture debt facility that's more than 20 to 30% of the most recent capital raise, right? So if you have raised $15 million, say a $5 million Series A and then a $10 million Series B, the number that is going to be the focal point in determining that amount is the 10 million Series B. While it's helpful to understand the total amount of capital that the companies raise, you really, for a lender, they're trying to understand what capital you'll have on hand. And now for the underwriting, and this is why I talked about the institutional venture capital piece. For underwriting, a lot of times event funds or banks are thinking about how are we going to get paid back? And that's a combination of two things. The company is going to make a ton of money. Their revenue is going to increase, and they can pay this line down as a function of increased revenue. But most often what happens, and because we expect the companies that we're lending to be losing money, the source of repayment, or the primary source of repayment, is going to be money from additional capital raise. So a lender in this space is really trying to understand what is the company's ability to raise more capital, as well as how do the investors in this space think about them and support them. So this comes down to signaling risk, as well as just the fund overall. So we want to make sure that investors not only believe in the company, but they have the funds and dry powder themselves to be able to support the company in the event that there's a rough patch, and that they're going to continue to help the company so that they can raise additional funds. And most times, folks either go back to refinancing this debt or just paying down the debt in general. So when is the right time for venture debt? This is really, really important, and something I want founders to remember and think about. So the right time for venture debt or exploring venture debt is precisely when you don't need it. So that's just as you're getting ready to close a round, or right after you close a round. And that's for a few reasons. You have a strong cash position. The number that the lender is looking at, you actually have liquid. And it gives us a better understanding into what the forward-looking vision for the company looks like. And like I said, again, this is meant to be a complementary, not a substitution. And something I see a lot of founders do, particularly second-time founders do, is they'll put this facility in place. And just because you have the facility in place doesn't mean that you need to draw down on it and actually use it. So some founders will put this facility in place as kind of a safety net, if you will. And in the events that, they do need to use it and draw down on it, they can. But in the events that they don't need to do that as well. And the reason that founders like venture debts is a few things. It lets you have more equity in your company. So most times what you'll see in the terms is a warrant, or the right to exercise a warrant. And so what that means is that and this ranges typically anywhere from 25 to 75 basis points. So it's a fraction of the cost of ownership that you are giving up to get access to this money. And for most institutions, they will only exercise the warrants in the event that there's a liquidity event. Other considerations to think about is the sentiment of your investors. So while we talked about, family offices, angel investors, and institutional investors, not all institutional investors are a fan sometimes of venture debt. So you want to make sure that your investors are comfortable with you taking venture debt, understand the need, and also understand how it makes them more aligned, right? A lot of investors want to make sure that the founders are properly compensated and incentivized to continue to work and be dedicated to the company as it gets larger. And so by being able to maintain more equity earlier, when you are giving up more equity down the line, there's still a large amount of equity left in the overall pool. So that's really important. Another thing is your banking partner and banking relationships. And this is why it's so important to evaluate your banking relationships early. So most times, if you're going with the bank, there's a requirement to do all your banking through whatever bank is providing the debt. And this is for a variety of reasons. One, making sure things are good and they can help you and service the loan as needed. And so it's really important to really build those relationships early and have a good understanding of what the landscape looks like. And to the extent that you do want to get venture debt down the line, what that process looks like and how they would be thinking and evaluating your company. So the typical interest, we get this question a lot. It's variable, of course, but it's mostly tied to Wall Street Journal Prime, and then 1 to 4%. And this is dependent on the markets. And term sheets can be negotiated, right? So you want to make sure that as you're getting terms that you're looking through and also making sure it compares to markets. And then another consideration too is senior debt and just thinking about liquidity clauses. So venture debt is considered senior debt. So that's just one thing you want to keep in mind, especially if you have plans to pursue other types of debts for the company. But for companies that have a large capital components or need a lot of capital to scale and have hit product market fit, venture debt is a really, really good solution to be able to maintain more equity and also have more leverage for yourself as a founder. So thank you. Here's the information for Grasshopper Bank. Always happy to chat. And I will take questions at the end. Thanks all.
All right. Thanks for having me, Bart. So always good to collaborate with an alumni from Indiegogo. So some quick background. I don't have a deck, but some quick background on myself. My day job now is as a venture investor. I started a $30 million fund based in New York with my partner, Cyrus Masumi. The fund is called Humbition. It's the words humble and ambition put together. We invest into Series Seed and Series A. We rarely are first money in unless we know the entrepreneurs for a long time, but we love writing 250 checks into some traction on seed, which to us traction means $250,000 of run rate revenue, and $1 million check into an A round. We love the verticals as marketplaces or health tech. We also look opportunistically outside of that. If you're a New York company, we love you tons. And if you're outside New York, it's definitely a chance we'll invest in you as well. But a majority of our portfolio right now is New York based. We have 12 investments to date. So that's the day job. With that said, my experience getting here was actually starting Indiegogo before the word crowdfunding actually existed. So I won't really explain to you crowdfunding generically because I feel like everybody already understands it. We launched in January 2008. I was CEO from day one till a couple of years ago, and we've distributed billions of dollars to date. I'll try to just quickly tell you some tips and tricks and how you could think about it to optimize an Indiegogo campaign, or if you want to use a competitor, it's pretty much all the same. So I'll simplify it to 3 things. 1, you want to create a good campaign. 2, you want to get off to a fast start. And 3, you want to maintain the momentum and keep the campaign fresh. So let's start with creating a good campaign. The components are all very relevant. You want to have a video. It doesn't need to be high quality. It doesn't need to be low quality. You need to know your audience as to what you're looking for. Usually you want to be between 1 to 2 minutes. You're going to want to make sure that you have the appropriate types of perks or rewards in return for your dollars that you're getting contributed. You want to have really interesting dynamic copy that's broken up, hopefully with imagery that you can keep it all fresh and exciting. And you're going to want to set your goal appropriately. Part of this is really managing psychology. So it's always better to under promise and over deliver. And people really who don't know you are more likely to fund the closer you are to hitting your target. So I highly recommend setting your target lower and really crushing it, because speed of dollars comes in faster as you get closer to 100%, and it does not slow down after you get over 100%. So in terms of the types of campaigns that there are, really when you're thinking about a rewards campaign, you're often thinking about products, tangible goods. Rarely are you thinking about a SaaS B2B software company. That's not to say that those aren't good companies, but they're just not as funded as much on a rewards-based model. Potentially where you're at might be good for equity-based model or bootstrapping or friends and family, but often rewards, you're going to want to see something in return. People want to get it cheaper. They want to get that $100 product for $50 first, or they want to be the first adopters. They want to have that water cooler talk or the virtual water cooler talk these days to say they've tried it out, or they want to be part of the community. They want to give feedback on how to make those earbuds or that e-bike or that amazing scooter better. So the more you could think about how to attract that audience, the better, by setting up your proper campaign. The second thing is you're going to want to get off to a fast start. So if you could actually raise 25% of your target within within 1 week, you are 5 times more likely to hit your target than if you're not able to get off to that fast start. So how do you get off to that fast start? A lot of people just think it's if you build it, they will come and they just, do their work, put up their campaign, and then they say, okay, platform, bring me the funders. Well, it doesn't quite work that way. If you can't get your own mother to fund you, or your own brother, or your own best friend to fund you, then why will strangers who have never met you want to fund you? There's a level of trust and integrity that they need to believe in, and it's hard to believe if the numbers are that low. So it's just kind of like in the venture world where somebody will say, well, who's the lead investor? Somebody wants to know that that preliminary diligence was done so that you could trust to them be a follow-on. And it's a little different because it's just a product sometimes, but others still don't want to be scammed. So you really need to have that preliminary traction first from folks that are in what I call your inner circle. So it's really important that before your campaign even starts, like Cheryl was mentioning, to have a pre-campaign experience on Indiegogo. You could actually have that as a functionality, but it just means that you're building your email list, you're testing your performance marketing, you're capturing your audience, you're actually leading them to the gate without letting them through yet. And then all of a sudden you open the gate and everybody rushes in. Now, if you didn't already build up that audience when you open that gate and all of a sudden it opens and no one's coming in, it's gonna be really hard for you to actually get traction. Because even if a platform, Indiegogo, any other platform, actually starts promoting you on their homepage, sending you in their newsletters, when all those eyeballs come and see that 0 funded, 9% funded, 21% funded out of 100%, they're going to run away. They're going to say, clearly, this doesn't have enough traction and validation and love, so I don't want to be the sucker here. So it's really important to invest a lot of time in advance of the campaign to build up that audience. I like to call it the inner circle. Sometimes identify the 100 names, literally the names, John Smith, Megan, Bob, like whatever their names are, and say, I need these 100 people to fund first, and for them all to try to get 10 people each. Imagine that. That's 100 plus another 10 times 100, which is 1,000. That would be 1,100 people who you're hoping to get funding right away from. That sort of momentum breeds more momentum. When strangers now see this, they're going to start funding. And then all of a sudden you can go viral in terms of getting a media hit or all kinds of exciting things. So that's the idea of getting off to a good start. And then keeping your campaign fresh. It's always easy to start a campaign. It's called launch. It's new. And it's always easy to end a campaign because the clock is ticking and this is going away with scarcity. But in between, you have what we call as the valley of death, which is how do you keep it interesting? How do you keep your campaign fresh? And this is where you want to keep on putting out updates, usually once every 3 to 5 days. You want to have new perks, that rewards that you introduce to the audience, kind of like a blue light special or something that never was available until just today. Or hey, audience, you just unlock this awesome new perk. And you want to try to get influencers to push or media to write about your thing. So these are the ways to keep your campaign fresh, because you really want to persevere through the valley of death, because the beginning and the end are usually the easiest parts. And what I would say is the people and the campaigns that make it look the easiest are the ones that have worked the hardest and have really put in that effort in advance. One of the biggest mistakes that I see all the time, and for what it's worth, I've been a part or have seen thousands of campaigns, is the campaigns that succeed is they treat the campaign as the time for their company to continue to develop. While the campaigns that often fail are the ones who say, our company is important and the campaign, I hope it works out because it'd be a nice win. Meaning it's either an island on the side, which is a distraction, or it is the entire country and it's the focus of what you're doing. Those that treat it as the focus for that period of time, 2 weeks, 4 weeks, 8 weeks, 12 weeks, 16 weeks, are the ones where often you see those hundreds of thousands, millions of dollars of campaigns. And what kind of traction should your company have to do an Indiegogo campaign? You could have no traction, and you could try. Chances are you'll have challenges. You could already have $10 million of revenue, and we have plenty of those companies. You can be a Fortune 500 company. We have plenty of those companies. It's really about what are you trying to do? Are you introducing something fresh to the market? Are you providing discounts, opportunities to get something that wasn't available before? Are you looking for validation? Are you in a new product? Are you trying to get engagement from your audience that you already have hundreds or thousands or millions of them already involved? It's really up to you, but those are usually some of the best things. And then obviously from there, you just continue to build your business. So I'll stop there to try to get us back on time. And just as a one-off thing, just because I can't stop being an operator, and that's really the essence of our fund. I kind of skipped over that. But as part of building our venture fund, Cyrus and myself, when we were operators for our two respective companies, Indiegogo and ZocDoc, we brought in what we believe are some of the best operators out there as investors. That includes Jeff Bezos, Mark Benioff, Nicholas Zenstrom, Megan Smith, brothers, Keith Raboy, Ben Ling, Richard Branson, and really operators, in our opinion, is where the best money comes from. And we just wanted to build that as part of the New York ecosystem. And the more you can expose yourself to that, whether it's part of an Indiegogo campaign to hear from other operators or from raising capital for your companies as investors, I suggest you surround yourself with as many operators. Obviously, if they can be full-time, great. But if they can be advisors or investors, that works out well too. So I look forward to any questions. And thanks again, Bart and WeWork, for having me.